I don't know where the correct price of silver is. But gold's going to keep rising too. But maybe silver should be 200. Maybe it should be 150 right now. Gold is going to go a lot higher. I mean, I think 20,000 is, I mean, anybody can just guess as to where this thing is going. But if gold goes to 20,000, which it obviously, look, given enough time, it will eventually be there. But, if gold goes to 20,000 within the next 5 years, let's say that happens. So it's not really gold going to 20,000. It's the dollar losing a substantial percentage of its purchasing power.
If you get gold up to 20,000, that's going to create $5 trillion for the U.S. Treasury if they want to revalue it to buy down U.S. Treasury debt. And then you can restructure the economy. It's essentially a giant currency devaluation where the bondholders of the world lose. And that's what has to happen. The debt's unrepayable. I would be completely unsurprised to find out 5-10 years from now that, if let's say we watch silver run up to, I don't know, 150, 200.
With the national debt deemed mathematically unpayable, analysts are projecting a future in which gold hits $20,000 and silver climbs to $150 or $200. However, this rise is not merely an asset bull market. It represents a collapse in the dollar's purchasing power. The only viable exit strategy for the sovereign debt crisis may be a massive revaluation of gold reserves. Peter Schiff, chief economist at Euro-Pacific Asset Management, and Luke Gromen, founder of FFTT LLC, discussed the mechanics of this inevitable financial restructuring. If gold is revalued to $20,000, the U.S. Treasury could theoretically unlock $5 trillion in nominal value to buy down debt. This giant currency devaluation essentially transfers the loss to global bondholders as the real value of their fixed income assets evaporates. This scenario is increasingly viewed not as a possibility, but as a necessity to reset an insolvent system. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Gold is going to go a lot higher. I mean, I think 20,000 is, I mean, anybody can just guess as to where this thing is going. But if gold goes to 20,000, which it obviously, look, given enough time, it will eventually be there. But, if gold goes to 20,000 within the next 5 years, let's say that happens, it's not going to happen in a vacuum, right? The price of copper is not going to stay at $6 a pound, right? It's going a lot higher too. The price of wheat, the price of oil, the price of everything is going to go up. So it's not really gold going to 20,000. It's the dollar losing a substantial percentage of its purchasing power so that the price of everything is going to go up. Now, I think gold will go up, proportionally more than a lot of other products, goods and services, but it's going to be high inflation that drives gold to that level. And you're also going to see the US dollar a lot lower relative to its fiat counterparts. So it's going to be in the context of a major US dollar bear market where you're going to see that kind of appreciation in the price of gold. And it's not going to be just central banks that are buying, but they're going to be buying more. But there's going to be a lot of private demand for gold, not just the industrial use case, and I'm talking silver too, but as an investment, as a store of value, like we haven't seen since the 1970s. You're going to see institutional investors, pension funds, endowments, mutual funds. They're all going to be allocating a portion of their portfolios to gold and silver, to mining equities, whereas in the past, and including the present, most of these institutional investors have no allocation, zero exposure to precious metals. And so they're going to go from 0 to maybe 5 or 10%, but that is a huge number when you contrast how much that is in totality versus the tiny supply of investable gold and silver or mining equities. And then you're also going to see the retail investor, for the first time probably in decades, getting involved. I mean, sure, there's always been a group of investors, maybe led by me, in recent years, the gold bugs. We've been buying gold and silver. We've been stacking because the events that are going to be transpiring, playing out, are exactly why I've been buying gold and silver and other people. I mean, it's not a surprise to me that we're going to have a dollar crisis. The only surprise is that we've been able to delay it for as long as we have. And that's allowed me to accumulate a bigger position, particularly in the mining stocks, because that's where I've been focusing a lot of my buying. And I probably would have been just better off sticking to all physical silver, but obviously that's just with the benefit of hindsight. But I've got plenty of silver. I got more silver stocks, which, they're up. My silver stocks are up 5x, 6x. But I actually, if you'd have told me a year ago or 2 years ago that silver would be $115 an ounce today, I would have expected my silver stocks to be at least double, if not triple, where they are right now. So, and I still think they're going to get there. It's just that kind of investors are in disbelief of what's happening. And so they're not pricing it in. I think a lot of people just expect the price to crash. And so they're not going to, start factoring in $115 silver into their earnings forecasts for these companies. But you know what? It doesn't even matter. The silver stocks are priced for maybe $50 silver at most. They're not priced even for $100 silver. So it doesn't matter if silver goes down. But the reality is, even if silver pulls back to 100 or 90, a year or two from now, it's going to be much higher than 115. So these companies are just going to make a fortune.
The problem is you devalue the dollar, you're going to send inflation up here, you're going to break the bond market. And that's going to break the bond market there. You devalue the yuan or the yen. It's going to break the bond market there. It's going to break the bond market. So there's an order of operations that has to be done. You can still do it. You got to take gold to $20,000, $30,000, $40,000 an ounce. And then you change, we have a provision in our financial accounting manual for Federal Reserve banks. I believe it's the Dutch central banker a couple of years ago said to Jan Neuenhuis, we have the gold revaluation account we can use. And you buy down the debt. And then you can start reorganizing currencies without blowing up the bond market. But any attempt to restructure currencies like the Plaza Accord, all you're going to do is blow up the bond market in days. And we saw that in April of last year, right? Trump did Liberation Day. The U.S. Treasury market started crashing 7 trading days later. And that'll keep happening until you buy down the debt with gold first. And is this move in gold starting to move in that direction? Maybe. I don't know. Hopefully, because I think it's very preferable to the alternative, which is the global economy burning down. Well, 25,000, maybe not at least. I just put a post up on my X feed that it's a chart I've been posting for years, and it's the market value of gold, market value of the United States official gold position. So just our gold reserves times gold's price as a percentage of foreign held treasuries outstanding. And that percentage was never below 20% before 1989 when the Berlin Wall came down. After today, as we sit here today, it's at 14%. So gold would have to run another 50% just to get to the level seen in 1989. The long-term average was 40 to 60%. So gold would have to rise another 3 to 4x from here. So 15 to 20,000 just to get to the long-term average. And in 1980, when we had an honest to goodness dollar crisis, it went to 135%. So gold would have to go up another 9x from here, or $45,000 an ounce in an honest to goodness dollar crisis. And as of, about a month ago, I would always say when I said this, I think there's no chance of an honest to goodness dollar crisis. I'm starting to think that there could be an honest to goodness dollar concern, right? Based on the actions of the last month or two as a culmination of all of the things we've laid out and of the last 25 years. So yeah, if you get gold up to 20,000, that's going to create $5 trillion for the U.S. Treasury if they want to revalue it to buy down U.S. Treasury debt. And then you can restructure the economy. It's essentially a giant currency devaluation where the bondholders of the world lose. And that's what has to happen. The debt's unrepayable. It is mathematically, that is a mathematical certainty. Now then, if you want to take gold to 20,000, you buy down $5 trillion of debt, particularly out the long end, and then you want to raise rates to 8% to fight inflation, great. You're going to have a recession, but you're not going to, right now, if they raise rates to 8% to fight inflation, U.S. interest expense would be, it'd be $2.8 trillion on $5 trillion in receipts, and receipts would collapse because it's all very interest rate sensitive. So, you would have $2.8 trillion in interest, and you'd have, 3.5 trillion in entitlements. So you would have 150% of receipts, 200% of receipts in entitlements and interest. and then you either default on the bonds or you print the money, right? They're stuck. So that's what gold does. Gold devalues sovereign debt once you get to the end of the road in the long debt cycle, and that's where we are.
The inevitable conclusion of the current long-term debt cycle points to a necessary and massive revaluation of gold, with models projecting prices between $20,000 and $45,000 per ounce. This forecast is rooted in the mathematical certainty that U.S. debt is unpayable in real terms. To avoid a total collapse of the bond market, the financial system requires a mechanism similar to a gold revaluation account, in which the official price of gold is reset to wipe out trillions in sovereign liabilities. This process effectively transfers losses to bondholders via currency devaluation rather than explicit default, fundamentally altering the global economic structure. Institutional investors, including pension funds and endowments, are expected to react by shifting allocations from near zero to 5 to 10% in precious metals, driving private demand alongside central banks. Meanwhile, silver miners remain drastically undervalued, currently priced for scenarios far below reality. Ultimately, with interest expenses threatening to consume all tax receipts, the Federal Reserve is trapped, leaving gold as the sole asset capable of devaluing the debt and solvently resetting the system. Let's get back to the interview.
People talk about, oh, the cost of living is going up, prices are going up. It's the dollar that's going down. Because if we still had gold as money, if we were still on a constitutional gold standard, prices would be going down. Everything would be getting cheaper, which is exactly what is happening. And that's what used to happen in America once upon a time when we had honest constitutional money. The consumer price index, on average, fell every year. We had declining prices and we had prosperity. We had a more prosperous society that delivered a more rapid increase in the living standards of the majority of the population back then under a gold standard than we do today. Central banks are buying gold, they're not buying silver, but silver was cheap. And meanwhile, the industrial use case for silver kept improving. There's more and more demand for silver, and there isn't the supply. And so there's been a big price mismatch going on for years. And maybe a lot of that was speculators who were shorting the market, who are no longer able to do that. But the price was really suppressed for a number of reasons. And I just kept saying, look, just buy it. I mean, people were upset that they thought that it was being manipulated. And I was like, well, don't be upset. Just go buy it. If they're doing you a favor, if they're artificially keeping the price of silver down, they're making it easier for you to buy it cheap. So don't complain about it. Take advantage of it. I would tell my clients that for years to buy silver. So now finally the market is repricing silver, trying to find where it needs to be. I don't know where the correct price of silver is, but gold's going to keep rising too. But maybe silver should be 200. Maybe it should be 150 right now. I don't really know. The market is trying to discover what silver should be priced at with $5,000 gold, right? But $5,000 gold is a moving target because gold's not going to stop at $5,000, right? Gold's going a lot higher than $5,000. I used to have a $5,000 forecast over a decade ago, but a lot of money's been printed since then. Because we kicked the can down the road on a dollar crisis a lot longer than I expected, my ultimate target for gold is now a lot higher than I initially expected. So this is not the end of this thing. We're going a lot higher, and we're just really starting to see the dollar break down. And ironically, the catalyst that has finally accelerated the process is Donald Trump. Donald Trump basically forced the world to act in its own interest sooner rather than later, right? With the tariffs, and what happened now recently with Greenland, and the things that he's saying about, how important the U.S. is to the global economy and how the whole world, it only works because of us, and that therefore we could do whatever we want. This is blowing back in his face because the world is really pulling the rug out from under our economy. because Trump has it backwards. The world doesn't depend on us. We depend on the world. And we're about to find that out the hard way.
I like silver. I've liked silver. I've owned silver for a long time. I've always thought that I'd much rather own gold because gold is ultimately a risk for, it's all a monetary asset. There's really no industrial dynamic. I think silver probably still goes higher in the short run, simply because, again, the United States government declared it a critical mineral in November. They weren't saying that because they wanted to spike the price so a bunch of paper traders could make money. That was, oh my God, we're short all of these things. And so, to your point, how do you stop being short all of these things? The cure for high prices, or the cure for low prices, and cure for high prices. I would be completely unsurprised to find out 5-10 years from now that, if let's say we watch silver run up to, I don't know, 150, 200, and we start to see big selling of coins, I wouldn't be surprised to find out that it's NATO governments, and in particular the United States of America, buying all of the physical silver that they can get their hands on. And that is pure speculation on my point. But again, when the United States government says silver is a critical mineral, they're not kidding anymore. Like they can print dollars. They need the silver, right? You can't put paper silver into an F-35. You can't put it into a cruise missile. You can't put it into solar panels. You can't put it into semiconductor chips, et cetera, et cetera. You got to actually have silver. And so, silver for me, like I said, I still like it. It's a small position. I was wrong about the gold to silver ratio. I really thought it would stay elevated. I think it still is relatively. It's compressed a lot. But I still don't think it's going back to the long term. You see it at 10 to 1 or 12 to 1. I don't think it's ever going back there. And in part, I think because of the industrial usage and what you describe, which is people will sell the silver. And at some point, the price goes up high enough, it starts to create demand destruction on the industrial side.
The rising cost of living is fundamentally a symptom of currency devaluation. Historically, under an honest gold standard, prices fell while living standards rose. This contrast confirms that the dollar is losing purchasing power rather than goods becoming merely expensive. For years, the artificial suppression of silver prices provided investors with a hidden opportunity to accumulate cheap metal. Now, with gold targets far exceeding $5,000 due to relentless money printing, the market is aggressively repricing silver to reflect its actual value in a fracturing currency system. A critical turning point occurred when the U.S. government officially designated silver a critical mineral. This shift acknowledges that paper derivatives cannot power F-35s or cruise missiles, only physical metal suffices. Analysts speculate that upcoming price surges to $150 or $200 may be driven by NATO governments quietly securing essential stockpiles. As the global economy pivots away from U.S. dominance, the reliance on tangible assets is becoming a matter of national security rather than just investment. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.